Thank you, Krishna. Hi, I'm Martiens Barnard, Head of Technical Marketing for Momentum Investments. I'm really excited about the topic I'm discussing with you today, as it's the first time I will be sharing months of research. In 2022, we launched our Retirement Reimagined campaign, and we showed how clients investing in a living annuity are at risk of falling into the living annuity risk spiral. This is because as people are living longer in retirement, they are exposed to longevity risk, and as a result, they have no choice other than to take higher market risk, hoping they would get higher return to maintain their income. As such, they are exposing their capital to market risk, and when markets don't perform, they have the risk of leaving a negative inheritance, as they are now living longer and their asset base may not have grown sufficiently to provide for them. It is because of that we've relaunched our living annuity. This was done to enable clients to choose a guaranteed annuity portfolio as a component within their living annuities. Today, I want to discuss our subsequent research with regards to the guaranteed annuity portfolio, or in shorthand, a GAP, and how it enables financial advisors to give personalized, holistic financial advice to enhance their clients' chances of reaching retirement success. I'll start off this session by providing some insights into what we've seen from analyzing our book of retirement clients. I'll then look at a case study of what the traditional outcomes would be when you use a medium or a high-risk investment in retirement. Then we're going to look at how you can diversify by using a guaranteed annuity portfolio within your investment portfolio and show how it changes the outcomes for our clients. And then we'll delve into the next phase of our retirement research to see whether the diversification on offer by a guaranteed annuity portfolio is in fact a free lunch. This then leads into the outcomes that we've seen on how you can provide personalized, holistic advice by using different asset classes to give an optimal solution to clients. So the options available to retirees are, of course, living annuities, with-profit annuities, and life annuities. We won't be discussing with-profit annuities today. And just to remind you that our hybrid annuity, that is the key topic of discussion today, is nothing but a living annuity that gives you access to a life annuity in the same manner that you would get access to a different fund or unit trust. One would think that a comparison is at hand when we're talking about hybrid annuities to say, how does the feature set of a hybrid annuity compare to that of a living annuity or a life annuity? But today, we're not going to be comparing these feature sets. Today, I want to talk about using a life annuity as an asset class to move away from a product comparison and to move into an investment portfolio optimization discussion, where the life annuity is an asset class, and we want to see the impact of using that to counter a client's longevity risk, market risk, and the impact that it has on a client's inheritance. But while on the topic of comparison, let's talk about the take-up between these two annuities in the recent past. In the previous financial year, we saw that 40% of the take-up of annuities was in fact life annuities, and that is a significant increase compared to our historical numbers. This increasing trend of transferring risk to life insurers by investing in life annuities have been driven mainly by the perceived risk of investment markets since 2020, as well as the high interest rate environment leading to higher incomes available from life annuities. The highlighted area here is the same decade than the one I just showed you, where we saw the shift towards life annuities. You can see that over this period, there's been a steady increase in the income levels. Do note that the axis here is between 5,000 and 10,000, just to zoom in a little on the bit to give more context. I also want to make the point that at the lower levels in 2013, a life annuity already gave double-digit returns, or IRRs, as we will discuss later, for retirees that lived from 65 to 85 years old. It was already giving good value for money then, it's just giving great value for money now. So that was life annuities. When we look at living annuities, we can see from our analysis of the book of Momentum Retirement Income Options that retirees are under pressure, and you can see that from the income drawdown distribution. There are a lot of retirees drawing high single-digit incomes, and many are drawing incomes that's even much higher. Do note that we've cut off the tails in this analysis because we believe that many of these annuitants may not be trying to replicate their income streams with those living annuities. But this way of looking tells one side of the story, since an investor that is withdrawing 8% from a living annuity at the age of 80 is in a very different financial situation than a client that is withdrawing 8% and is aged 60. And as such, we need to look at this in a different light, and we need to look at the income drawdown distribution across each age. Now, what you see here is a spread of the same clients as shown before, with the left-hand axis being the income drawdown made by retirees and with age at the bottom. Here, the size of each bubble represents the number of clients in a cohort. When we look at these cohorts individually, we can estimate the return that they would need to maintain their incomes in real terms up to the age of 90. And this is how the equation unfolds. The dark green bubbles at the bottom of the heat map represents the clients that are better funded for retirement, and you can see there's not that many of them. They don't need a very high return from their investments. The light green bubbles are the clients that's probably at the income drawdown levels as prescribed by the academic literature that says you should start off with the income drawdown level in the region of about 4.5% to 5.5%. And basically, all clients above that is facing a more complex financial equation, as they might have to chase returns in excess of, for instance, 9 to 10, 11 to 12, and even much higher returns for a very long period of time, sometimes up to 3 to 4 decades. And this is an after-cost return. We can probably add about 1.5% to 2.5% to get to the gross returns needed. When we look at this one specific cohort, and this is where we'll draw the case study from, we'll talk about a fictional client called Greg, and we will talk about his financial setting. Greg is drawing 7% of income from his living annuity as per the vertical axis. He's age 65 as per the horizontal axis. And since he's in the orange range, he needs a return of more than 11% to make his retirement equation work. But more about Greg later. What is very interesting to note here is that at the age of 75, the red bubbles start at a 10% drawdown. But if we go back to a client age 60, the red dots are already starting at an income drawdown level of 8%. So even though these clients are at different drawdown levels, they are in the same financial situation. These living annuities, and I should probably add the orange and the yellow ones, are under immense pressure, as the required net returns should be 13% and in many instances much higher. Again, from a gross of fee perspective, we are looking at a return needed of about 15% and much higher as you move to the upper end of the table. These clients may very well already be in the living annuity risk spiral as discussed before. We can again switch this analysis back to a single distribution, but not in accordance with the drawdowns, but in accordance to the required return needed to give a better understanding to where these clients find themselves in terms of their retirement. As you can see, many are already in a very difficult situation. And remember, every movement to the right by 1% isn't just a return of, for instance, 10 to 11% over a single year. It's a return needed that is 1% higher for an extended period such as 25 years. Think about the compounding effect of this extra 1% over such a long time period. This places a high level of strain into each client's retirement equation, and using the traditional asset classes to try and solve this places clients at the mercy of the markets, and there is an inherent risk in such a strategy. Let's go back to Greg. and look at how he can optimize his chances using the traditional asset classes. If Greg invests into a medium equity investment, this is a long-term distribution that we believe he would receive from this investment. The red bars indicate groupings of simulations where he would not get the required return needed to sustain his income. We believe there is a 47% chance of this happening if he lives up to the age of 90. His alternative is taking more risk and investing into a high equity investment that gives a higher expected return. This improves his chances of maintaining his income, as he now only faces a 41% chance of getting a return less than 11%, but this strategy can produce much lower long-term outcomes if severe investment market downturns occur. And this could lead to a severe loss of income for Greg from a very early stage of his retirement. In addition, this high-risk fund could lead to a behavior tax, as Greg could make switches that can be to his disadvantage. In today's session, we want to unfold how these returns could impact on Greg's ability to reach a successful retirement. But we are going to start off slowly by looking at a single simulation. That is one that is returning just under 11% to build up this case study. So let's first look at the financial equation we're trying to solve. So Greg is retiring at the age of 65 and is investing in a pure living annuity. He's investing 2 million Rand, but the investment size doesn't really matter because the 7% starting income is the key parameter. It will hold for any investment amount if we stick to 7% as a starting income. And to be honest, that's about the mid-range of what we're seeing on the Momentum Wealth platform. So his income needs escalates by 5% per year, and he chooses a medium risk fund. In this part of the case study, Greg is not trying to optimize for inheritance. He's just trying to optimize income certainty, and as such, we are ignoring inheritance for now. When we overlay the simulation that performs at just below 11%, his income drawdowns would look as follows. What we see is that Greg would have been able to maintain his income until the age of 83. At this age, he would hit the 17.5% cap on the living annuities, and from now on, his actual income would not be sufficient to meet his income need. And at the age of 89, Greg would only be able to receive 50% of the income that he was hoping for. In our assumptions, we've said that 50% of Greg's income is needed to pay for his essentials. So basically, he would not be able to pay for his life expenses from the age of 89. This is, of course, for a simulation that performs just below average. Other simulations might do better and might be able to maintain the income for longer. Out of interest, I would score the performance of this simulation at a level of 4 out of 10. It performed below average, but the performance wasn't really that bad. But what is important to understand is the coloring that was used. While the simulation is able to pay the full income, we show it as green. It turns yellow when it can only provide for more than 50% of the income need, and it turns red when the income is less than 50% of what Greg wanted. Now, I can show this differently. I can show you the simulated income as a green bar to the age of 83, as a yellow bar to the age of 88, and then as a red bar for the remainder of the simulation. Now, this was for a below average simulation, the 4 out of 10 simulation. For a better performing simulation, an average performance or a 5 out of 10 performance, Greg was able to get his income up to the age of 88. And for the 6 out of 10 simulation, or the above average simulation, Greg was able to maintain his income up to the age of 100 years. And what you're seeing here is the introduction into an income map. Here, we've assumed the world can only have 3 states. And if you look across these states at each age, you can understand the probability of Greg being in a certain state of income at a certain point in time. So initially, at the age of 65, Greg would get the income that he wants. As we move across the ages, the chances of Greg getting the income he wants is starting to reduce. And if at the age of 90 there was only 3 states in the world, Greg would have had an equal chance of being in either state in the income scenarios, of getting the full income he needs, of getting more than half of the income he needs, and getting less than half of the income he needs. But of course, the world doesn't work like that. And as such, we simulated 2,000 market realistic states to understand the chances of Greg being able to maintain his retirement income, and we show this as an income map. In an income map, we want to see as much green as possible. And you read it by looking at a certain age, for instance, at the age of 90. Here, you would see that at this age, there is a lot of green, a little bit of yellow, and a medium amount of red. What that means, when you look at the circular chart, is there is a 48% chance of being in the income state that gives you the full income that you want. There's a 13% chance of being in the income state where you get more than half of the income that you want, and there's a 39% chance of being in an income state where you are getting less than 50% of the income you wanted. Looking at it differently, in terms of risk, point number 1 shows you sequence risk and the risk of a short to a medium-term market downturn. Here the chances are still slim that the client isn't getting the income that they want, as there's still a lot of green at this age. It is only in future simulations where the market has given severe underperformance or where there was severe sequence risk upon entering into the investments that this should happen. At point number 2, there is a bigger chance of the client not getting the income they want. Here, it's not only significant underperformance that is placing the client's income at risk, but market performance that is just below the expected return could also place the client's income at risk, very similar to our 4 out of 10 example. At point number 3, there is a bigger chance of Greg not getting the income that he wants than getting the full income. This is due to longevity risk, with Greg not getting the full income that he wants even when markets is performing as expected. The alternative is to move to a higher risk type of investment. And here we can see more green on the income map when it takes on additional risk. But when we compare the medium risk investment to the high risk investment, you can see that even though you should perform better more often, in the long term, you run out of income earlier when markets crash. And you also have a higher chance of the client incurring behavior tax, which is not showcased in the income map, but that would certainly lead to more yellow and even red. And that brings us to the topic of diversification and asset allocation. So as we've mentioned, our conversation today is about including a life annuity as an asset class into an investment portfolio. Normally, when the conversation turns to asset allocation, everyone thinks about the efficient frontier, the red line I'm showing here. And here, investment portfolios are put together to try and get the maximum expected return for the minimum amount of risk. Now, that is in the traditional sense what is used to optimize an investment portfolio. But in the retirement reimagined research that we did last year, we didn't optimize purely for risk and return. We optimized to try and minimize market risk and longevity risk through the use of an income map. So let's do a quick refresher. So again, the equation is as before, but now Greg is investing 35% of his assets into a guaranteed annuity portfolio. That is 700,000 Rand that is invested into a gap. And that gap will be paying an income of about 5,600 Rands per month, escalating at 5%. But before we look at the impact of this different asset allocation, let's quickly talk about the returns you get from a life annuity, because it's important to understand this before we talk about improving overall diversification. For an asset class to give great diversification benefits, you firstly want to talk about the asset class that gives a high return, but you also want to talk about an asset class that reduces the risk of the overall investment portfolio. To do this, you're looking for an asset class that grows when others are falling and falls when others are growing. That is a negatively correlated asset class. And even though the gap does not do that exactly, it's still giving you a great benefit because it's an uncorrelated asset class. Because markets does not have an impact on the income that you get from a life annuity once you have purchased that life annuity. So let's talk about the returns then from a life annuity. We always think about the initial income we get from a life annuity and think about that as the return that you are getting. Yet a client that gets, let's say, 100,000 rands worth of income in the first year from a R1,000,000 life annuity is not getting a 10% return if he dies in that year. He's in fact getting a minus 90% return if he dies after year one, because R1,000,000 is invested and 100,000 rand is returned. Yet, if he lives for about 10 years, the client would have received back all the capital that was invested in the form of income. This essentially means you get a 0% return on your money. But after that, every year you live longer than that, the return that you get from a life annuity increases significantly. The black line indicates the internal rate of return, or the IRR, that was received from the life annuity when we launched the hybrid annuity in 2022. You could see that returns flatlined there at about 13.5%. And with the increases in interest rates, we are now already seeing returns just under 15% for Greg if he remains alive for an extended period. Now, these type of returns has a tremendous impact on the chances of Greg achieving success in retirement. And that can be shown by looking at the income map. When a guaranteed annuity portfolio is included into the investment portfolio, you can see that the amount of green is much larger than before. In actual fact, the red is almost pushed completely off the income map. Of course, the 50% life expenses was an arbitrary number. And if his life expenses was a larger proportion, you would see more red. But I think that's not the point here. The point is, we have to look at green and non-green. But what did Greg give up? Was his lunch entirely free? Of course not. Anyone that has a crystal ball and can see into the future, knowing that markets are going to give exceptional performance, should rather invest into a living annuity than a life annuity. Because what Greg gives away is the potential for very strong market returns. Yet the converse is true. Let's look at this analysis, and what I've done here is I've taken all 2,000 simulations and I've ordered their returns when using a pure living annuity, and I've ordered them from left to right, from the worst to the best performer. You can see for most of the time, the living annuity was giving a return of between 5% and let's call it 15 to 16% returns. If I introduce a life annuity into the investment portfolio, of course you will give up some of the upside performance. But when markets aren't performing well, you basically get a hedge against significant underperformance. And that is why you're seeing the changes in the income map. The movement of the yellow and the red to the right and the bottom of the income map. But that isn't the total cost. A pure life annuity does not offer an inheritance value upon the death of the annuitant. And this feature sparked the thinking into the second phase of our retirement reimagined research. So let's turn our attention back to the original simulation. That 4 out of 10 simulation when using a pure living annuity. Greg's living annuity market value would have looked like this under this simulation. It drifted sideways, not really maintaining its real purchasing power. That is because Greg is always selling market-linked assets to fund his income. In actual fact, Greg's assets almost maintained its nominal value for a decade before his value started to drift downwards as the impact of drawing an increasing income stream from this reducing real capital base started to have a drastic effect on the value of his investment. If the maximum income drawdown level did not exist, this value would have fallen to zero very quickly from this point onwards. I can again show this to you in a very different way, and the thinking is very similar to the thinking behind the income map. Now, I don't have to show you all these details. I can just show you the market value line in blue, white, or red based on whether it's above these lines I'm showing on the screen. So in this instance, this line would start as white and maintain that color for a few years, whereafter it would turn red. And in doing this, I can show you 2,000 simulations in one go to give you an idea of what to expect in the future. And that is what we call an inheritance map. It looks intimidating at first, but let me break it down by focusing only on two ages, 70 and 90. What we're seeing at the age of 70, when you look at it vertically in that age bracket, is that there's a lot of blue and a lot of white and very little red. This means that Greg had a 46% chance, based on our assumptions, that he would have been able to maintain the real value of his investment, but also a 3% chance of not leaving an inheritance should he pass away that is less than 50% of his real investment amount. By the way, I'll be talking about everything in real terms from now when I'm talking about inheritance. So to be in the situation of leaving less than 50% of the original investment amount as an inheritance, it means that markets had to either perform really badly or that there was significant secret risk in Greg's investment. When we look at the age of 90, we see the opposite. We see that in most cases, the inheritance value that Greg's nominated beneficiaries would receive would be less than 50% of the original purchase price. But there was a chance that Greg's living annuity would be able to provide an inheritance that was higher in real terms. It would probably be the instances where he accidentally invested at the bottom of a recovery, or it would be in the instances where he would have invested in the start of a bull run, giving his living annuity that opportunity to grow very well up front. So that is an inheritance map. What you're looking for is a lot of blue and a little bit of red, and for the red to start as late as possible. Now let's see what happens to an inheritance map when you introduce a gap into the investment portfolio. But first, let's think about it logically. There is no inheritance from a gap. What is very interesting is not to look at the start in isolation, but to also look at the end of the inheritance map, and I want to focus your attention there on the blue section in the top right-hand corner as I introduce the gap into the investment portfolio. This shows there is a reasonable chance that introducing a gap can actually increase the inheritance that you leave to your nominated beneficiaries at extended ages, but initially the opposite is true because there is no inheritance from a gap as expected. And I again want to show this to you in the light of that single simulation just below average return scenario, and it looks as follows. You would see the investment starts at a value of 2 million Rand, but that the investment with a gap has an inheritance value of only 1.3 million Rand. But because of the income payments from the gap, over time, the second portfolio has the opportunity to play catch up. And in this simulation, it doesn't always happen. It crosses over and it actually leaves a better inheritance value for the beneficiaries. And as such, you could see the positive impact on the right-hand side of the inheritance map. And it was with this thinking in mind that we looked at the initial research and asked ourselves, how can we optimize for inheritance so that the client does not have that initial shortfall in inheritance? And so, Retirement Reimagined Phase 2 was born. Optimizing the asset allocation in the light of the client need when the client need is to minimize market risk, longevity risk, and to optimize for inheritance across his lifetime. To build on what we've already discussed today, the case study now looks at Greg, but now he has informed us that inheritance is really important. And as such, we're not going to use a gap in the normal sense, but we're going to be using a gap with a 25-year guaranteed term. I want to show it to you in the extreme case, and then you can apply this thinking based on your specific client needs. But I first want to show you the impact on the IRR of adding a guaranteed term to the gap. This gap would have a starting income of 4,600 rands per month, also escalating at 5%. To understand the change in the IRR, we need to realize that when you add a guaranteed term, it has an impact on the guaranteed income, but something else happens upon death within the guaranteed term. So firstly, the impact on the income in this instance was a reduction from 5,600 rands to 4,600 rands. Now bear in mind, I'm using a 25-year guarantee term, the longest term you can choose. For instance, say a 15-year guaranteed term would already have a much lower impact on the income. To understand what happens upon death, we need to talk about the commutation of income. When the owner of the living annuity dies within the guaranteed term, and there is no second annuitant, we will pay out the present value of the remaining income payments in the guaranteed term into the living annuity. And it would look as follows. If Greg dies at the end of year 10, the income of 4,600 Rand would already have increased to 7,500 Rand, and we would take the present value of the remainder of the income for the next 15 years and pay it as a lump sum into a living annuity. And the overall impact that it has on the IRR looks as follows. Greg's IRR has a pattern that starts close to around 12% at the prevailing rate of income, and it remains above 11% up to the end of the guaranteed term. Now that has a profound impact on the inheritance value in the initial years, as you don't see that immediate drop anymore. And it has a profound impact on the inheritance map. And the effect is as follows. Where the above inheritance map uses the normal life annuity and has an initial shortfall, the gap with a guaranteed term of 25 years produces an inheritance map that looks very similar to a pure living annuity. So, as a financial advisor, you can provide personalized financial advice by flexing the length of the guaranteed term of the gap. Thus, we believe that adding a gap can have a profound impact on the income certainty that a client can have in retirement, but also that you shouldn't look at income certainty in isolation. You should also look at inheritance, especially when that is important for the client. So let's look at the traditional strategy and how the income and inheritance map looked. And then we can look at an income map when you introduce a gap with no guaranteed term. You can see a very large improvement in income security, but with an initial lower inheritance amount which phases out over time. And for a client that does not want this initial reduction in inheritance, we look at introducing a gap with a guaranteed term, which also leads to a higher income certainty than a traditional portfolio, but with a similar inheritance map. And of course, there are many guaranteed terms in between 0 and 25 years. It's all about what the client needs and what they consider to be a priority, income or income and inheritance, or anything in between. And as such, you can look at your new clients and your clients across the Momentum Wealth book and personalize their financial advice according to their needs and their inheritance needs based on their financial circumstances. It is for this reason that we are introducing the Income Illustrator to help you with personalizing your financial advice. With the Income Illustrator, we show the effect of adding a gap. We do this by simulating our future expectations of new and existing living annuities with and without a gap, and by highlighting when the income that the client will receive becomes unsustainable, when the income will start to reduce, what the income would be at the planned age, and projections of the investment value. The income illustrator is an evolving product. It does not yet showcase the effect of adding a guaranteed term and the effect that it would have on a client's inheritance, but I hope that with this research, you will have all the knowledge of implementing guaranteed terms to personalize the inheritance needs of your clients. So in closing, we believe that we can reverse the living annuity risk spiral by including a gap as a hedging strategy against market and longevity risk, as it can reduce longevity risk, reduce the risk of an initial low inheritance or a negative inheritance, and it can reduce your reliance on market returns as it gives you an investment portfolio that is less exposed to market risk. Thank you.